Good evening, everyone. Welcome to a new session at LearnApp Live. And how are you guys doing? Let me know in the comments. And today we'll be talking about future retail as a case study. And we'll try and understand a few concepts around things to look at as an investor, things to avoid as an investor, and what are the things that always meet the public eye and what are the things that are obvious things that can miss the public eye, right? And we'll use future retail as a case study to understand this. So just a brief overview of the flow of today's presentation. We'll first and foremost try and understand the retail landscape in the country. We'll delve a little deeper on the concept of what an enterprise value is. And then, as a retail investor, we always tend to hear a lot of news, there's a lot of noise. So we'll try and understand how to distinguish the news from the noise. We'll understand briefly about the concept of borrowings and other financial liabilities that can often miss average retail shareholders' eye, right? So, without wasting much time, let's just delve right into the presentation. So, in today's presentation, we'll be using future retail as a case study. Now, future retail, as you know, is the is the company that is behind marquee brands like Big Bazaar, Central. It earlier used to own Pantaloons and then it had to sell it to the Aditya Birla Group. So we'll use future retail as a case study to understand these concepts, right? So first and foremost, let's just dive into the retail landscape of our country, right? So when we think about retail in the country, right? Basically, think about your Kirana store, think about the large format stores, think about malls. So till date, despite so many malls coming in and despite a lot of these large format stores, there's Spencer's, there's Big Bazaar, there's D-Mart, 80 to 90% of the Indian retail still happens through the Kirana store, and it is largely in the unorganized segment, right? It's only 9 to 10% of the Indian retail which takes place through organized channels, and that also includes e-commerce, by the way. So, in a way, retail landscape in the country is fairly skewed towards the unorganized part, which is your Kirana stores, the local vendors, the street vendors, and that is where 80 to 90% of commerce takes place, right? So, first and foremost, to delve into today's industry that we are looking at, which is organized retail, that still forms a very minuscule part of the overall retail landscape in the country, right? And that is basically termed as modern trade. And the fact of the matter is, since this is a very new sector and it is still emerging, now this is where a lot of investors are trying to get their money into. So if you look at, say, the kind of valuation DMart is commanding right now, or for that matter, Reliance Retail's unlisted shares in the grey market. I mean, it's always there in the news that today the grey market premium has increased, so on and so forth. So a lot of investors want to get into this space. And why is that, right? Because it is still at a very nascent stage in our country. And a lot of investors are banking on the fact that in the coming decade or so, or in the coming period, there could be a huge value migration. So if I were to draw a parallel here, if you were to compare it with, say, how the banking landscape changed in the country. So a lot of value migration happened throughout the 90s into the 2000s from public sector banks to private sector banks. And that is when you saw stalwarts like HDFC Bank, Axis Bank, ICICI Bank develop and take a lion's share from the public sector banks. Similarly, there's a similar thought process that's going on around retail. That a lot of this value migration will happen from, say, the unorganized space into the modern trade. Now, a lot of different players are putting in different bets. So, for example, if you look at, say, Reliance Retail and the kind of communication that they've done with JioMart, they want to consolidate the Kirana space. So they want to empower the Kirana stores and get into a omni-channel model, right? Now the public and the most of the experts are yet to see how this pans out, but that is precisely how it is, right? And if you look at now coming to today's example of Future Retail, now Kishore Biani, the person behind Future Retail, he had kind of revolutionized Indian retail in the country, and we've seen him develop these brands, Big Bazaar, Central. He's also done a few smart acquisitions to get into the tier 2, tier 3 cities and bring large format stores into the Indian consumer, right? And concepts like the Great Indian Shopping Festival, getting people access to the touch and feel and understand how modern trade works. So Kishore Biani has been instrumental behind that. Now there has been a lot of flip flop in the communication that a lot of times Kishore Biani has done. So initially, if you see when Big Bazaar started, when a lot of these future retail outlets started, there was a lot of chatter around. Kishore Biani was very vocal against e-commerce, right? And he said that e-commerce in India does not have a future. India will still work on the traditional retail model. We would still want to go to a physical store and buy things. And at the same time, he kept developing his own value chain around retail, right? So he got all the stores up. He got a very brilliant supply chain ready in terms of supplying groceries, supplying say apparel to the stores, so on and so forth. And in a way, he was all set that if tomorrow a Walmart or say a Costco wants to come to India, they might just look at future retail as the candidate to get a stake in, right? And then things changed. Future retail got a little over ambitious. The competition opened up. They took on a lot of debt, which caused concerns around their profitability. Kishore Biani had to end up selling pantaloons to the Aditya Birla Group, right? So a lot of these things happened, and then you could see the narrative changed around future retail and around how Kishore Biani used to think about e-commerce. So from a point of view where he was vocal against e-commerce and he said that look, e-commerce does not have a future in India, future retail ended up buying a stake in Pepperfry, which is an online furniture retailer in the country. And for all you know, Amazon bought a stake, I believe as early as last year, into one of the future retail companies. And in a way, what Kishore Biani right now is doing is they are trying to leverage the tech of Amazon with their Big Bazaar stores to get their SKUs up and running and as a new channel to sell online, right? And as a twist of fortune, you would say, right? Flipkart ended up being acquired by Walmart. So there was a lot of you can say flip flop that has happened in the industry as well, and at the same time there has been a lot of changes to the status quo that has taken place. So just to compare, just to do a slight comparison, now let's just dive into the numbers, right? Now this is data that is available as on yesterday. So the market cap that you can see on the screen is as on 7th August. So I mean, Future Retail, DMart and VMart, right? Now VMart again is present in tier 2 and tier 3 cities and is a small retailer that is having a lot of these large format stores. DMart, as you all know, is promoted by the legendary investor Mr. Damani, and is right now a darling of the Indian stock market. And Future Retail, which is the case study today, and we'll try and understand more about Future Retail today. So diving right into the numbers, if you look at the market cap of Future Retail, it is close to $1 billion, less than $1 billion, so it's around 5,900 crores. And if you look at DMart, it's around 140,000 crores, which is almost 21 to 22 billion dollars. So almost the kind of premium that DMart commands over a Future Retail is close to 20x, right? Now, one way of looking at it is DMart overvalued, right? Why is DMart being valued 20 times that of Future Retail? Is DMart doing something which is exceptionally really good, right? So let's just get into the sales figure, right? So Future Retail closed the last 12 months sales. So the number that you can see on the screen, now we'll get into what is exactly happening behind Future Retail right now. So as a matter of fact, Future Retail has not filed their Q4 earnings, At the same time, they've not filed their Q1 earnings as well. So as early as I believe last week, they've seeked an extension from SEBI to delay their filing of results. So till now, whatever numbers are available is till Q3 of last year, which is till December of last year. So the performance, the financial performance that Future Retail has taken from say the month of January to August till date is still yet to be filed with the exchanges. So that again leaves us with some incomplete information to do this comparison, but based on what the data is available, you can see that the sales of both the companies are almost in line, right? So DMart is probably doing around 2000 crores more in sales than Future Retail. So the question that should come to one's mind is valuing DMart 22 or 23 times that of Future Retail just for a difference of 1000 crore in sales. Okay, now coming to the net profit, Future Retail made a profit of 708 crores compared to DMart, which made 1000 crores on a sale of 23,000 crores. So again, if you see, there's roughly 40% difference here, right? But again, if you were to compare the numbers between sales and net profit, now see, firstly, we have to acknowledge that large format retail as a model has very cutthroat competition amongst itself, right? So there are very razor thin margins. So if you look at any, you go to any large format stores, you find them in the high streets of the world. So obviously rental costs are high, right? At the same time, you will see there's a lot of manpower that goes behind. So that again is a major cost that they have in terms of their manpower, in terms of their overheads, which is the rent, the electricity, and the maintenance costs. So these can take a toll on your profitability. So as it is, we are operating on razor thin margins here. Now DMart, it is said that they own a lot of the land that they put their stores up in, and they don't get into leases or they don't try and rent things out. So that helps them keep a check on the overheads, and they end up owning those assets. So that could be a reason why the street is valuing DMart almost 20 times that of Future Retail. Now there are two ways of looking at this scenario, right? The first and foremost is, why is it that DMart is being valued 20 times more than Future Retail? Or the other way to look at it is why is Future Retail valued at 1/20th the value of DMart despite having similar level of sales, right? The first and foremost and the obvious thing that comes to any shareholder's mind is that, hey, this is undervalued, right? But at the same time, you have to acknowledge the fact that markets are very efficient, right? And they generally tend to discount things further. So if there is a reason why Future Retail is being valued 1/20th that of a DMart with respect to sales, and even if I were to compare it with the smallest retailer in the organized space, which is VMart, on a sales of 1600 crores, they are valued at 3200 crores. So they are trading at almost 2x the sales. So even if I were to do that, the benchmark for Future Retail in terms of market cap should have been at least 42,000 crores. So roughly $6 billion, right? So the one argument could be that, hey, okay, Future Retail right now may be undervalued because of certain reasons, and we'll look at those reasons why we see Future Retail not being valued as that of an organized retailer. But at the same time, the other way to look at it is to look at it, to take a step back and look at it with caution and look at it with a certain iota of doubt as to why is it that the market is trying to value an organized retailer which has so many marquee brands to its name at such a lower multiple, right? And even if you were to look at, say, the debt levels, you can see the debt in Future Retail is close to 10 times that of DMart, close to 6 times that of VMart. And in terms of promoter holding, because of offloading of debt, getting other investors on board, there has been the shareholding of Future Retail has been paid, and it stands right now at 40% in terms of what the promoter group holds. Now, after understanding this data, right, let us delve into the concept of what an enterprise value is and why enterprise value is relevant. So whenever a company is up for acquisition or whenever a company wants to put itself up for sale, uh, it has to be valued as a going concern. So the idea is, if today I have to sell Future Retail, or Future Retail would want to sell itself and be a, say, a candidate for acquisition, how exactly would you value future retail, right? So you would look at the enterprise value of future retail and what exactly today future retail as a going concern, as in terms of its overall value, would be valued at. So, just to keep it as simple as possible, the way to look at enterprise value is the market cap of the firm plus the net debt of the firm. So, market cap basically is the total share capital into the current market price plus whatever net debt the company has. Now, what is the idea behind net debt? Now if you've followed the news for close to a year, Reliance has been telling that, look, we want to make ourselves net debt free, right? Now there's a fine line of difference between debt free and net debt free, right? So if you were to look at the second point, net debt basically means the total debt that I have on my balance sheet minus the cash. So the idea is say today if I were to acquire future retail, it may have certain cash in its books. So I'll use that cash to pay off the debt, right? And that brings me to the net debt that future retail holds, and or any company holds for that matter. So that gives me the concept of net debt. Now the other way, if I were to delve more into cash, so this again comprises of cash and cash equivalents. So a lot of firms, what they do is instead of holding cash in their bank or in their hand in their balance sheet, they put it in certain short-term investments. So they are generally clubbed with cash and cash equivalents, but a lot of times what happens is this cash also sits under short-term investments. So firms may want to park their money into a liquid fund or into, say, a overnight debt fund. So what happens, there's some reclassification that takes place. So some of this amount could be parked in short-term investments. So this can also be used to liquidate and pay the debt off and arrive at net debt. So that is briefly how we were to look at enterprise value of a company. So coming back to our example, so if we were to look at the enterprise value of future retail, the way to value future retail would be to add up the market cap and the debt. Now, future retail has 200 crores of cash in its balance sheet. So we would net off that 200 crores of cash from the debt and add it to the market cap to arrive at a enterprise value. So that is how we look at enterprise value of a firm, right? So news or noise, right? Now, off lately, we've seen future retail has been in the news a lot. There are talks about Reliance trying to pick up the whole stake in future retail, and future retail is up on the block for sale. And a lot of this news flow is happening, right? And this has not been happening for a week. This has been going on for close to a month now, right? So if you see the first time the news broke, ET broke the news that Reliance and Future Retail are in the process of finalizing share sale agreement. There was news Reliance might buy a minority stake in their FMCG business to control Future Group's assets. Now, the first news that broke was that Reliance is doing negotiation talks with the debt holders of Future Retail to take a haircut so that the EV can come down, right? Now if you recall our discussion from 5 minutes back around enterprise value, so any acquirer, so let's just assume that Reliance is going after this acquisition, which presently has not been confirmed, and a lot of times media keeps speculating a lot. I mean, the last year we've seen a lot of this speculation happening, right? Especially when Yes Bank was going down, there were talks that Microsoft buy a stake in Yes Bank. Off lately, almost 3 weeks back, we heard Google is buying a stake in Vodafone. So a lot of this news flow keeps coming in, and it's always us, the who are the retail shareholders, tend to make something out of it and see that, okay, maybe this might happen. Let's just buy some shares from the market. I mean, I still remember a year back there was news that Warren Buffett's Duracell might be buying out Eveready, and for all you know, Eveready corrected almost 50-60% from that level. That again is again, we'll be discussing about that as a case study also in the upcoming weeks, right? So the first and foremost thing that as retail investors we have to be cognizant of is markets are very smart, right? And once a news is made public, right, and we think that, okay, so maybe Reliance, let's just assume that Reliance is all set to do this, right, which presently has neither been confirmed. At the same time, it has been denied by a lot of their exchange filings, which we'll see in the further slides. So let's just assume for a moment that Reliance is going ahead with this deal and this is happening, right? So it is important to understand that while Reliance might be doing this, right? So what exactly as a retail shareholder do you have a leverage on? So in terms of if this news is already public or if this is already a done deal, how much do you think this would rally, right? Now that again, I mean, there could be a huge upside there, and at the same time it could still remain flat. So tomorrow, say if Reliance denies that no, we are not doing this, or say if this deal does not happen, then you can see the price of future retail correcting. Now future retail from time to time has been in the news for a lot of this action that might be taking place. So what is happening, a lot of times their volumes keep going up and down, and time to time the exchange seeks clarification from future retail as to why exactly is there so much movement in volume happening, right? So just to show you as an example, right, let me just open Screener and give you an overview of what exactly I'm trying to say here. And let's just go to future retail and let's look at the chart of future retail, right? So if you look at the last 1 year share price graph of future retail, you can see the price has been on decline, right? It was around 400 rupees a year back, and right now it's close to 100 rupees. So almost it has lost 75% in value, right? And if you look at the volumes, right? So the volumes are there on this graph, and if you see, like suddenly after the price is dropped, the volume action has been tremendous. Like volumes have been shooting through the roofs, north of 16 million, 17 million shares being traded in a day. So a lot of volume is happening in terms of after in the last 1 or 2 months, which again, there are two ways of looking at it, right? First is maybe this deal is happening for sure. That is one way of looking at it, and the other is a lot of people might just be doing a lot of speculation here. So always whenever things like this happen, it's not always obvious. That is the one message or the one conclusion that I can give you, that this may not be obvious, but at the same time, there's no certainty that this would go through. So if I were to look at, say, how the shareholding movement has happened, right? So if you see the promoters, which once had around 50% share in June quarter of 2017, they have pared their stake to almost 40% now. So almost 10% of their stake has gone out. I mean, if I were to look at the foreign institutional investors, they've also reduced their stake from close to 17% to around 12%. Now, if you see, almost 15% of the block has flown from the promoters and the foreign institutional investors in the last 3 years. And this 15% of the block has equally landed between the domestic institutional investors and the public shareholders, right? So you can see that swiftly both the foreign institutional investors and the promoters have been selling stake in the company. Promoters because of the reasons with respect to pairing of debt or trying to get strategic investors on board. At the same time, it's the public shareholders like us and the domestic institutional investors which are picking their stake up in the company, right? So getting back into the presentation, so all this news has been doing a lot of rounds that Reliance is all set to buy a stake in the company, so on and so forth, right? Now, this was the first clarification that was sought from the company. Now, this is the reply that was given by Future Retail to the exchange. So if you see that, and for the ease of reference, I've just taken out the screenshot of the release which was uploaded by Future Retail to the exchanges. And if you read through here, right? So the first time this news broke was in 27 March 2020, and they said that with regard to the stake sale by the promoters, we wish to clarify that at present there is no such activities which is in knowledge of the company, and as we are committed to inform the shareholders about any definitive transaction, but would avoid giving any disclosures about possible transactions to avoid any speculative activities, right? So they had clearly denied that such news or such discussions are not underway, right? Now, again, if you look at the news which recently broke, which again brought Future Group into the interest of retail shareholders back again is that Reliance might be buying a stake, right? Now the clarification which I showed to you was this was again dated March 20 when there were talks about Future Retail selling stake to get in more investors on board, because right now we if we look at the financials of Future Retail, there have been defaults by the group, right? So we look at the debt profile of the company and then we'll try to relate these discussions with that. Okay. So, I mean, if you look here, there were talks that Reliance might buy Future Group's retail business for close to 27,000 crore. Now, again, this was first the clarification which was issued by Future Retail. So they clearly mentioned that, yeah. So they clearly mentioned that, look, uh, the management and the company continues to explore and evaluate various opportunities as and when there needs to be a disclosure that needs to be made, which is binding on the company. The company would make that disclosure. At the same time, they've also mentioned that there is no disclosure that is required to be done presently, and whatever is happening is we are unable to comment on the said article. So this was the clarification which was issued by Future Retail. Now, since Reliance's name was also mentioned in the article, a similar clarification was also sought from Reliance. So this is what Reliance had to reply, and I'll just show that screenshot to you on the same day. So, Reliance also categorically denied it. We are unable to comment on media speculation and rumors, and it would also be inappropriate on our part to do so. We keep evaluating various opportunities on an ongoing basis. Further, there is no information which has not been announced to the stock exchange, which should have been announced, and we'll make the necessary disclosures as and when it comes to light, right? So this is in terms of the news flow that has been happening. Now, this news flow, now there could be a possibility that this might happen, there could be a possibility this not might happen, but as a retail investor, we cannot be making an investment decision based on this news, right? Because for us, it is also very important to look at what the financial position of the company is, and that is where that should be the driving factor of our investment decisions. Now, whether this deal happens or not, I mean, if the first and foremost step is to evaluate, say, the financial profitability or the financial position of the company, right? And before before we get comfort around that, there's no point putting your money into a stock unless you don't have the conviction about it. The other way to look at it is, say, okay, I do not go through the financials. Maybe I see that Future Retail is a great brand. I put my money in, and tomorrow maybe this Reliance deal happens, and my stock shoots through the roof, and I make a lot of money during that. So that again would be a purely a speculative bet that one could make. But it's very important to be clear in your head as to what exactly are you doing. So are you investing in Future Retail, or are you trying to make a speculative bet on the transaction? Now, before I continue with my presentation, I would be happy to take any questions if you guys have, and if you have any questions, you can just drop in as a live chat into the chat box, and let me know if I have any questions that I can answer for you, right? Okay, so now the other reason why a lot of news flow has been happening around Future Retail as well. I mean, as early as 2 weeks back, we saw that Future Retail has been delaying filing their results. Right now, just to give you a perspective, this is not the first time a company has delayed their filings, and you know they put out a disclosure saying that, look, right now we are working on limited manpower, and because a lot of their offices are in containment zones, they're not able to complete their consolidation process or complete their audit, and which is why they're having delays in filings. Now, the idea here is, look, it was almost, I believe, last year, if I were to just draw a parallel here, Yes Bank also was going through a similar route here. Okay, and Yes Bank also delayed their filings multiple times, And again, I'm not saying that both of these are comparable, but if I were to look at cases that were coming in terms of where companies have delayed their filings, this is the most recent example I can think of. Now, for their results related to 31st March, which is almost 5 months ago, so January, February, March, for those results, right? For those results, the company has said that what they would be doing is they would want to do this filing till 31st August, and as on first quarter, which is April, May, June, they would want to get their filings done by 15th September. So what is the actual position of future retail as on last financial year? An individual investor like you and me would only get to know it on 31st August, right? And why it is important for us to understand what the current financial position is because the debt position or a lot of financial position before this was not very rosy to look at, and that is what we'll be putting a lot of time behind in terms of our discussion around the company. Okay, so Nitin has a question: how much extension company can get to delay their filings? So Nitin, as per the listing guidelines of SEBI, for every quarterly results, I believe the time limit that you can get as an extension is roughly, I believe, between 30 to 45 days from the close of the quarter, and like within which you have to do your filings. But I think because of COVID, SEBI had put in some relaxations that the companies could willingly extend their filings. But it's always a red flag if you ask me in terms of why a company would delay their filing. So it's understandable that okay, March was very random. COVID hit us, and suddenly everyone had to work from home. So a lot of A-listed companies, a lot of the bluest of the blue chips did do their filings a little later. So normally when they would do their filings in the month of, say, end of April or first week of May, they did it in the last week of June, right? And at the same time, the June filings happened faster. So it happened by the month of July. And right now we are in August and we are seeing a lot of companies coming out with their Q1 results. But this right here, right? You have results pending for March, which is almost 5 months back. And you're again asking for an extension for which you want to publish the results by 31st August. And for Q1, you want to publish it by September. So that's almost a delay of close to 8 to 9 months, right? So that is something which can give you a certain sense of discomfort. But at the same time, you have to be cognizant of the things that are happening, right? So I hope that answers your question. Okay, so coming directly into the concept of borrowings and other financial liabilities, right? Now, why is this important? Now, we all know borrowings of any company would consist of, say, short-term debt, long-term debt, and debt. A lot of times, in terms if you're running a business, you would want to finance it using your own money. And say when you need to expand or when you need to take in more money, you can use debt as an option. You can infuse more equity into the business. So you have multiple options available in terms of infusing money into the company, debt being one of them. So whenever you raise debt, based on the maturity profile of your debt, it either sits into your short-term liabilities or it sits into your long-term liabilities. So that is the way to look at borrowings. Now, the other concept here is other financial liabilities. Now, an interesting part about other financial liabilities is it does not sit into your borrowings, right? And a lot of times, what companies do is, say, for example, I have a debt of, say, 100 crores. And this 100 crores is payable every year for 10 years. So, what I need to do is I need to repay 10 crores every year, right? Now, what happens is, say I have 100 crores of debt and 10 crores is payable this year. So in my balance sheet, what I'll do is I'll show 90 crores as borrowings and I'll show 10 crores as current term maturities of long term debt. So this is the concept which I would like to introduce here in terms of how exactly can companies use this tool to show their disclosures separately, right? It's a little confusing, but again, what happens is it's important to be cognizant of this fact and not just look at borrowings in isolation. So the moot point here is whenever we look at a debt position or a debt level of a company, borrowings alone will not do the trick for you. So it's also important to look at other financial liabilities. Now, I believe in the starting quarter of this year, there were changes in the Indian accounting standard around leases. So a lot of companies which are heavy on leases, right? So it could be a mall operator, it could be an airline manufacturer, it could be a retailer, right? So all these things could be a reason for one to look at. I mean, all these things, uh, companies which are heavy on these leases. So India basically tells you that look, you have to recognize any lease that you have in your books as a financial lease, and you have to classify it in terms of your in terms of classifying that lease as having an ownership over it, and appropriately apportion the interest cost in your P&L and recognize the liability of that lease in your financial statements. And we'll get into it as we go on further, right? So Ravi has a question: why is filings delay considered as a red flag? So look, Ravi, I mean, the idea is that as a company, now I can understand there could be certain reasons why, say, you had to delay your filings. I mean, there could be a possible reason that maybe you did not have a lot of information available, or there was some problem or the other due to which you had to delay your filings. But that delay could have been, say, for 15 days, for 20 days, for even a month, right? But in this case, what has happened is the last financial position that I have about future retail. So I am literally, next month I'll be in September 20, right? Now specifically in the Indian context, what happens is companies are required to disclose their balance sheet on an annual basis, and in their quarterly filings, the balance sheets are not disclosed except for September. So you open up any quarterly disclosure of any company in their financial statements, you will find that the balance sheet is available only in September and only in March, right? So if I were to just go further with my presentation, you'll see that future retail now, March 19 was the last financial year, like the annual report that they had filed, and after that, in their September earnings release, they had filed their balance sheet in a detailed way, which is why you can see the data popping up here in Screener, right? And that is how, I mean, the last financial position that I have available about future retail, specifically in this case. So that is of as on September 19. So I don't have the March 20 position, and then that should be the latest position that should be available with me, which is after 6 months from September 19. And right now I'm literally sitting 1 month away from September 20, right? So that kind of gives you a sense that uh, I do not have much information available with me, and we'll get to that, which will also answer. Rushil has a comment that some companies declared their Q4 results this month. Yeah, so a lot of companies have been declaring their results lately. So the idea here is, if I have a lot of debt in my books, right? Number one, I would want to know that what exactly is happening here, right? Just to give you a perspective, I had two news articles open. Now, okay. So before getting into that, let me just show you why this is important for us to see. Okay, so as on March 20, Future Retail had set out an investor presentation where they showed their debt levels. So what they showed was that look, as on 30th September 19, we had 39,821 million rupees of debt. So that translates to roughly 4,000 crores of debt, and they did a bond issue of 3,560 crores, right? So this total, the total debt of this company becomes almost close to 7,000 crores, right? And 7,500 crores, that's close to $1 billion and above. And they said that look, we've done some warrant conversion, so basically we've infused equity into the company, and as a result of that, our net debt position leaves us to around 6,042 crores, right? Now uh, now this is why it's a red flag as an investor for me here, because had I not seen this investor presentation, if I just go by the financials, I do not have an overview about what exactly the current debt position of future retail is, right? So future retail has debt of close to 6,042 crores as on date. Now, if I were to look at the news flow around this, right? Let me just exit this presentation once. Yeah. So, as on 22nd July, there was a news that Future Retail misses interest payment on 500 million bonds as liquidity position deteriorates, right? If you look at another news flow that happened, there was Future Retail's IDR, which is international, issuer default rating, right? To see suggests exceptionally high level of credit risk. This was again there in 24th July. So, amidst all this news flow of the acquisition happening of Future Retail, a prospective acquisition of Future Retail being done by Reliance, this could have been this news flow was again there, right? So the reason why specifically in this case I am emphasizing on the fact that okay, this filing could have been a red flag, because see, as a retail investor, this can miss our eye. Like, we could just open screener here and see that okay, you just see that debt here is around 4,000 crores, and then again you see there's other liabilities of close to 11,200 crores. So that is where we'll again do some discussion around as to what exactly this possibility could be. But the idea is, as on current date, which is March 20, which is the latest available disclosure that Future Retail has given us, the debt position is close to 6,042 crores, which is almost equivalent to their market cap. Now, going right back into our discussion of enterprise value, right, where we spoke about how exactly were you to look at enterprise value. So you look at market cap plus net debt. So market cap of Future Retail is around 6,000 crores. The debt level in the company presently is around 6,000 crores. So we can say that comfortably the enterprise value of Future Retail today is 12,000 crores, right? And I again getting into say the filings that have happened, right? So the news that was doing the rounds is Reliance might be buying Future Group retail business for close to 27,000 crore. So now, on the basis of the data that's available with us, it's close to, like, our back of the envelope assumption tells us that Future Retail is probably valued at 12,000 crores, around 1.4 or 1.5 odd billion dollars, right? And at the same time, you're seeing that the acquisition price, which is doing the rounds, is 27,000 crores, almost 2.5x of what exactly is there. So there could be some other line items which are hiding, right? Or if I were to say that okay, Reliance is ready to pay 2 times the multiple of enterprise value to buy Future Retail, which again should give you a moment of doubt to consider as to if something is really valued at say 12,000 or 15,000 crore, why would someone pay 2.5x times of that to buy it? So clearly there could be some other things as well. Now this is where again another thing comes into play, is the contingent liabilities that the company might have. Now, contingent liability as a concept is basically, say, if the company has certain cases pending against it, which the company might feel may materialize or may not materialize. So it generally comes as a footnote in your balance sheet. It does not form a part of your financial statement. And Screener does a fantastic job in capturing a lot of that data. If you see here, like you can see contingent liabilities is close to 4,000 crores here, and promoters have pledged 75% of their holdings. Now see, the promoter pledge thing again, a lot of times it comes as a red flag to investors like us. But maybe the promoter has his own personal commitments, which is why he is pledging his holding to buy something, or to raise debt, or to do some other stuff. But again, the discussion here is around the company. So if I were to just look at the company, they have contingent liabilities of close to 4,013 crores, which might materialize, which might not materialize. But again, it's a risk, right? And this data to us is available only till March 19. It's not available till March 20. So, which is why, getting that filing or getting the correct information, the up-to-date information is important for any investor for us to make a decision. So, a lot of companies like Rushil, you mentioned, a lot of companies declared their Q4 results this month. So, obviously, I mean, if you do not have any concerns around the company, you go ahead and continue with your investments. Or if you're invested in a company, stay invested, right? But where you need more clarity. So for me to do a complete analysis of what exactly could be the true value of future retail today, it is important for me to know what their current financial position is. And so, which is why I said that a delay in filing here could be a potential red flag because I do not have the full information available, right? And okay, Ravi has a question. Can you please tell in debt what exactly comes under debt? So Ravi, when I speak about debt, it kind of covers everything. So long term, short term, both the debt position is covered there. And so if you use Screener to look at financial data, so in their borrowings, they generally club both long term and short term debt into it, right? So continuing with our presentation, if you look at the latest available information. Now, we've already seen that the debt position of future retail right now is close to 6,000 crores, which is almost equivalent to their market cap. And, raising a debt of 6,000 crores at the same time, if you look at my reserves, it's so any company's net worth is basically the sum total of share capital and reserves. So they have reserves of around 3,200 crore, their share capital is 100 crores. So 3,300 crore is their net worth today, as on September 19, because I do not have the information after that. Now, on a net worth of 3,300 crores, I have a debt of 6,200 crores. So almost two times is my debt to equity ratio, right? Now, generally, if you see companies that are debt heavy, they generally companies that are say into infrastructure projects or companies that are building roads or doing a lot of big turnkey projects or doing some capex, right? So in terms of building a new factory or adding new capacity, they take a lot of debt with the anticipation that my liquidity in the forthcoming years might improve because say I'm adding capacity. So say right now, if you see specialty chemicals is a sector which is quite hot right now, right? And a lot of these companies are doing a lot of capex to add capacity because suddenly they are seeing an uproar in demand. So the idea is you take on debt, you build a new capacity, and using the volumes of those capacity, you sit on a comfortable liquidity position, and you use that liquidity to service your debt. At the same time, getting off your debt swiftly, thereby improving your profitability. So that is the whole idea when you take debt. Now, a corollary of this is debt can also be an issue for you. So, almost a year back, there were concerns around whether, no one has been averse to debt, right? So, a year back, you could, when Reliance, if I were to take the example of Reliance, they had a lot of debt in their balance sheet, and there were talks going on. Will Reliance be able to deleverage itself, so on and so forth? And finally, when you saw the whole deleveraging exercise take place with a slew of announcements coming in, a lot of these investors putting in money, and Reliance finally saying that look, we've completed our deleveraging cycle. You saw how the stock skyrocketed, right? And because no one wants, like, for any investor or for the market, it is always essential to look at a company which is say low on debt, because see, if now a thing like COVID-19 happening was not factored in into anyone's projections, right? No company would have been prepared that okay, COVID happened, what do we do now? No one in their any model would have even predicted it. But the fact that it happened in a company like Future Retail, where a lot of the shopping happens physically, they suddenly are in a soup because their stores are closed, sales are not happening, and then they have a debt overhang, which again, mind you, is in foreign currency. So it becomes all the more difficult for a company like Future Retail to service this debt, right? And continuing with our presentation, if you see here, while the borrowings was at 3840 crores, you can also see other liabilities suddenly shooting up from 4,000 crores to 11,000 crores. Now, this again, when you kind of expand that, right? So you'll see this other liabilities of 11,200 crores has trade payables, right? So this could be the money that needs to be paid to the vendors, the suppliers, etc. So that's roughly 2,600 crores. And then there's something called a other liability item, which has suddenly shot up from 9,000 crores to 8,500 crores. Now, what exactly is this line item, right? So this could be two things. So one, as I mentioned, there was a change in the June quarter of accounting standards around accounting around leases. So that basically tells you to recognize all your lease expenses as a lease liability. So say before this, what was happening is any company that had a lease, what they had to do is it would come normally simply as a line item as an expense, and it would get expensed off. But the idea is a lot of companies enter into long-term leases. So it could be more than 10 years, it could be more than 5 years. So companies had said that, look, it is important for you to recognize this as a liability, as a long-term liability, and accordingly charge interest or depreciation against this in your books, right? So what this basically does is it gives the investor or anyone who is reading these financial statements a more clearer picture on what exactly your obligations are. Because see, tomorrow it's not that if you're not doing sales or if you're not doing revenue, you will not pay your lease, right? You have to pay your lease. So in a way, what would have happened is, say if you owned this asset, now land per se would be a part of your asset. Now again, land is not depreciated, but on land you would say have buildings. So those buildings need to be depreciated from time to time, right? So this was form a part of your depreciation expense. So someone who had this on lease would be averse to this, and somehow the financial statements would feel lighter. So just to give a more realistic view of this whole thing, this accounting standard change was brought, right? And if you see now coming into their quarterly disclosure, quarter on quarter, if you see their interest and depreciation cost, interest again because they took on debt, and depreciation again because the liability had to be reclassified as a other financial liability. So you'll see right from June quarter, right? Interest suddenly shoots up from 60 to 240, 260, 260. So almost 4 times their existing obligation. At the same time, depreciation almost shot up 8 times. So from 32 crores went straight away to 240, 260, 270. So, I mean, if I were to look at my operating profit margin, while it has swiftly improved from almost 5% to 12, 13, and 14%, because we can say that, okay, a lot of cost control measures were done, a lot of profitability measures was implemented, and that is why the operating profit of the company improved. But it came at what cost? At the same time, I had to reclassify my leases. I took on a lot of debt. So, my liquidity position got affected. So, at a PBT level, I almost went back to my September 18 levels, almost below that to June 18 levels. So, in the last 3 quarters, I have almost reduced myself in terms of the profitability that I enjoy. So, these are obvious things that a lot of times we can miss. So the idea behind this presentation was just to give you a flavor of how to delve deeper into looking at borrowings. At the same time, looking at, say, any accounting changes that keep coming and how companies can use that to maybe not give a very holistic picture. Because companies here are giving you a holistic picture, but as a retail investor, it might be difficult for you to understand what exactly is this happening. So the idea here was to introduce you to the concept of other financial liability, which is a lot of times can be used to house certain things under it. At the same time, to show you that despite the operating profit margin improvement, the net profit has kind of declined, right? So this again becomes important. Now we've already seen this, the debt position that Future Retail had, and in terms of the debt position right now. Now let's just come right back to the article. Now, in the interest of just repeating it once, we've covered this earlier. They missed their interest payment, which was due on this the foreign debt that they had raised. The credit rating of Future Retail was cut, citing reasons around their credit risk. So Fitch had downgraded their ratings, right? So these are again things that are important to consider before making an investment decision here. And finally, Future Retail. Now again, you have to give credit where it is due, right? Credit to Future Retail to give an exact position of what the maturity profile of this debt is. Now, see, out of this 6,042 crores of debt that Future Retail presently has, they are saying that 60% is payable after 5 years. Okay, so the tenor in dollar bond is 5 years. 30% of this debt is 1 year working capital facilities, which is due in 1 year. Right? And again, there are INR term loans which are payable after 2.5 years, right? So even if I were to see that the recovery becomes very important in the next 1 year, because see, after 1 year this is payable, right? After 11 years, after 2.5 years, this amount becomes payable. So 30% of 6,000 crores is almost close to 1,800 crores. And at the same time, it also becomes important uh, that look, after 5 years, 60% of this dollar denominated debt needs to be paid. Now, while they have said that look, we have hedged this cover, right? And if you go through this presentation, they've mentioned that they've hedged this cover. But again, there's a big currency risk that they are carrying, right? Because hedging again comes at a cost. You cannot have contracts which are hedged for 5 years. I mean, it needs to be rolled over every year, every 6 months. So that again has a cost. So which is why it is important to look at this debt profile and understand whether you're comfortable with this risk. Now, if you think that okay, future retail will be able to churn out more cash and be EBITDA positive, I mean, churn out more money effectively, and for some reason cut their costs, maybe get into online model because of their partnership with Amazon. But again, presently, if you see the retail landscape, the whole value migration has come back to the Kirana stores. It was already with the Kirana stores, as I mentioned at the starting of the presentation. Close to 90% of retail still happens there. That may have just gone up to say 95, 96%, right? So, so this is very important for anyone to look at. And we've already seen the shareholding pattern changes that has happened, and the promoters have been putting their shares off, the foreign institutional investors have been putting their share off, and this has been migrating to the domestic institutional investors and the public. So that kind of concludes today's presentation. And if you like today's class, do not forget to like Learn app, and you can always use the comments below to have any questions. And I'll just quickly go through the questions, because I see a lot of questions popping in, and try and answer them as quickly as possible, right? So Rushil has a question as to why there is 0% tax. Great question, Rushil. So a lot of times, companies have certain tax benefits that are available with them. Now, there could have been a possibility that the company might have incurred losses earlier, because of which they had certain deferred tax credits. So that is one reason they could be offsetting that, and ending up paying no tax altogether. The other reason is a lot of times government of India gives you incentives around doing certain projects in certain areas or in certain phases. So maybe they could have taken advantage around those, and that is why probably there's no tax here, right? Okay, Ravi has a question. This could be outlook for reaping future cash flows, as many suffer losses currently, thereby breaking even in current years. Okay, so yeah, I mean, that's one way of looking at it, right? That in the future there could be further cash flows, and that will help me in break even. But presently, if you see the debt profile and the whole credit risk that future retail is carrying is huge, because see, the stores are not opening up, right? And even if, let's just assume tomorrow all the future retail stores open up, we cannot see, or we cannot expect to see a huge recovery coming in there, right? And that in a way will still have my cash flows a little stretched. So the two options that I have to do is maybe do an asset sale, maybe I end up selling a few of my stores, or maybe selling my stake. But at the same time, if you see what's happening around the real estate industry right now, right? So around the real estate industry also a lot of haircut is happening. People who really need money have to do a lot of haircut deals. So that kind of creates concerns around here, right? Okay, another question is, do you think e-commerce like Amazon, Flipkart, Grofers will eat up DMart share in medium to long term in tier 1 cities? So look, as I mentioned in the starting of my presentation, right? A lot of these, a lot of these retail activities that take place, they are generally they're generally around. They're generally around the unorganized space, which is the kirana and the street vendors. 10% of that happens in the organized segment. This could go up to 12, 15 in the near to medium term, based on how companies are able to leverage technology, and especially with COVID around, people not wanting to move out. So sure, what would have happened is, companies like Amazon, Flipkart, Grofers, and they're actually, stepping up and trying to do that servicing done. But again, DMart here is not really sitting quiet, so they are also doing a lot of initiatives in terms of doing those van deliveries to a lot of complexes, etc. And that there is happening, right? So to answer your question, maybe in the medium to long term, DMart may not have that big a threat, uh, compared again to the fact that they don't have any fixed commitments in terms of, say, their lease payments. Sure, salaries still remain, but a chunk of these costs are specifically around the overheads. So if your stores are not opening, you're low on electricity, you're low on maintenance, you do not have to pay rent because DMart literally owns almost all their stores. So that's that. Okay. If COVID would not, yes, Ravi. So yeah, I mean, if COVID would not have happened and if status quo kept on going, uh, I mean, maybe we could have seen better light of the day in terms of my financial position. But again, it is important to see what exactly my return on capital employed is, right? So if I were to look at the return on capital employed of Future Retail, let's just take one moment to get here. So if you see Future Retail, I mean, comfortably they were sitting in a return on capital employed which was above, which was in the benchmark of 17 to 20%, right? So again, as a rule of thumb, my return on capital employed should be above the range of 16, 17% for me to sit comfortably in terms of, say, meeting my cost of capital obligations. So, because see, roughly, if you look at in this country, the cost of capital ranges into in the 10 to 13% range. So, any return above that puts me in a comfortable spot. That is the way to look at it, irrespective whether COVID is there or not. So, yes, till there, they were looking at themselves in a very comfortable position. Nitin has a question. As per India's, we have to capitalize lease for operating. Yes. So yeah, I mean that's what I mentioned, and that basically sits on your liability side, and it generally comes under your other financial liability. Yeah. So thanks a lot, guys, for tuning into this session, and we would be happy to take any more questions. I believe this class would be up, and if you still have any questions, you can tweet to LearnApp on Twitter, or uh, and I would be happy to answer any of that questions. Yeah. So thanks a lot for tuning in. Have a great day, and wish you a great weekend. Stay safe, right? Stay indoors and stay safe.
No, no.